A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hello, folks. This is David McKnight. Welcome to the Power of Zero show. I am the best-selling author of The Power of Zero, Look Before You LERP, The Volatility Shield, and as you've probably figured out by now, my latest book, Tax-Free Income for Life. It's going to be launching November 17th, but feel free to pre-order it now on Amazon or wherever you buy books. And you can go over to davidmcknight.com and you can enter the receipt number and you can claim Chapter 1 for free, and that'll be just enough to wet your whistle until you get your book in the mail. If you are looking for someone to help you navigate all the pitfalls that stand between you and the 0% tax bracket, you can head over to davidmcknight.com and click on Strategy Session. We'll be happy to hook you up with a member of our elite POZ advisor program, an advisor that's been trained, vetted, and qualified in the Power Zero paradigm. There's not a lot of those across the nation. We'll be sure to make sure that's the person we refer you to. And if you are an advisor who wants to transition your practice to a Power Zero practice, by all means, head over to powerzero.com and we'll be happy to chat with you about it. Today is the first of 3 podcasts in the run-up to the release of my book, Tax-Free Income for Life, on November 17th. And today we are going to be talking about the surprising benefits of guaranteed lifetime income. Now, one of the things that I talk about in my book is that there is a massive risk that retirees face. In fact, it is the risk that they are most concerned about, as evidenced by survey after survey. Some of you may be thinking it's tax rate risk. It's not tax rate risk, although that is a massive risk that looms on every retiree's horizon. The risk that I'm talking about is longevity risk, the likelihood that you will outlive your money. You will have too much life at the end of your money. And one of the ways to mitigate that risk is simply by way of an annuity. And you may be thinking, hold on, did Dave just use the most verboten term in all of retirement planning? Annuity? I sure did. And if you're thinking, hey, doesn't Ken Fisher despise annuities? He does despise annuities. He actually doesn't despise the types of annuities that we're talking about in today's context, because he recognizes that if you don't like the types of annuities we'll be talking about in today's podcast, then that also means that you don't like Social Security or you don't like company pensions, all of which utilize the same actuarial approach that the income annuities that we'll be talking about today. Now, there are a number of surprising benefits of guaranteed lifetime income annuities. We're not going to get into different types of guaranteed lifetime income annuities today. We're just going to talk about the benefits. We will do that in a subsequent podcast. The first benefit that we're going to talk about, there's basically 5. The first benefit we're going to talk about is retirement predictability. And overwhelmingly, the biggest benefit that you are going to get from guaranteeing your lifetime income in retirement. And by the way, when we say guaranteeing your income, we're basically saying guaranteeing the amount of income required above and beyond what is provided for by your Social Security and maybe a company pension. So there's that little, what we call an income gap that has to be accounted for. And the first benefit that a guaranteed lifetime income will give you is that it will plug that gap, and it will do so in a guaranteed fashion. So the first benefit really is retirement predictability. You can completely mitigate longevity risk. You can have a guarantee that no matter what happens to the stock market, you will be getting a paycheck automatically deposited into your checking account. And no matter how long you live, you're going to have to somehow, some way find a way to spend that money. So that's the first benefit, retirement predictability, knowing that money is always going to come in, even if you live to be 105. The second benefit of a guaranteed lifetime income annuity is that people that have these types of annuities that can guarantee their lifetime income generally have much less anxiety than those people who rely on the stock market. And we know this because the Wall Street Journal came out with an article, back in 2005. It says, "The secret to a happier retirement, friends, neighbors, and a fixed annuity." So basically, what they did was they surveyed a bunch of retirees, and what they found is that those that had guaranteed lifetime streams of income were much happier than those who relied on positive returns in the stock market to achieve their retirement goals. And this has long been true. When your income comes in, do you talk to anybody who is maybe a retired school teacher? I've got a number of friends who are retired school teachers, and they get guaranteed income, and that income comes rain or shine month after month, and they generally seem to be pretty happy people. Okay, I'm not going to say 100% anxiety-free retirement, but certainly much less anxiety than those who have to rely on the stock market to achieve their retirement goals. Now, this next one may surprise you, okay? And so it's number 3 on our list of surprising benefits of a guaranteed lifetime income annuity. And that's that you will likely live a longer life. So in other words, if leading a stress-free retirement isn't enough to get you over the hump, what we found is that studies have shown that those who have guaranteed lifetime income annuities live longer. Now, you may be thinking, hey, wait a minute, these are skewed because people who have lifetime income annuities generally have more money, and those who have more money generally are healthier, therefore they live longer lives. Now, while that may be the case, the studies further show that when all factors are being equal, guaranteed lifetime income annuities still extend life expectancy. In my book, I quote Stephen Dubner of Freakonomics fame. He says, it's that little extra incentive of the annuity payout that keeps people going. And of course, many of you are familiar with the Jane Austen phrase from Sense and Sensibility, where she said, people always live forever when there is an annuity to be paid to them. Okay, the next benefit, number 4, and I think I've got 5 in all. Yeah, five benefits in all. So number 4 is retirement on the cheap. And what I mean by that is if you consider that people who rely on the stock market to meet all their retirement goals have to abide by what was formerly known as the 4% rule, but what most experts agree is the 3% rule. In other words, you can only take 3% of your stock market portfolio, 3% of your beginning retirement balance day one of retirement. You only take 3% of that in any given year to be able to have a reasonably high expectation that you'll never run out of money in retirement. The problem with that is it's a pretty expensive proposition. So consider the math on the following scenario. Let's say you need $100,000 to meet your lifestyle needs above and beyond whatever pension or Social Security you have. And that's a pre-tax number. To figure out how much money you would have to have by day one of retirement, you'd have to divide 3% into 100,000. That tells you would need $3,333,333.33 by day one of retirement to be able to have a reasonable expectation that you will not run out of money in retirement. Now, that is a lot of money, and most retirees will not reach that goal unless they do some pretty austere things like save more, spend less, work longer, die sooner, or take more risk in the market to pull that off. The fact is that you can simply mitigate this risk with much less money by utilizing an income annuity. For example, if you were to use, say, a SPIA, and that's not necessarily what I'm recommending, but if you were to use a SPIA under normal interest rate environments, a 65-year-old might be able to take between 5 and 6% income per year. So you give them, so figure out how much money you would need to generate $100,000 of pre-tax income in that scenario, and it's about half the amount. If it's 6%, it's half the amount. So what's half of $3,333,333? It is $1,666,666.67. And if it's a 5% withdrawal rate, obviously you would need to put a little bit more, $2.2 million or thereabouts. That is less expensive than $3.3 million. So it is a risk that can be mitigated for fewer dollars. You don't have to save massive amounts of money. And what that does is it also frees up a lot of money to help you invest in the stock market. And that leads me to my next benefit. My next surprising benefit of guaranteed lifetime income annuities is given that you can mitigate that longevity risk with much fewer dollars, you now free up a much greater portion of your stock market portfolio to remain invested in the stock market. Now, because you've created an income floor, if you will, you've guaranteed that your lifestyle income expenses are going to be met, rain or shine. This gives you a permission slip, as it were, to take more risk in the stock market. Why? Because if the stock market goes down, you're not going to be forced to take money out during that down year because you have your guaranteed lifetime income to cover all of your expenses. You have the luxury of waiting till the stock market recovers before you access that money to pay for things like discretionary expenses, like those aspirational expenses or those shock expenses that invariably arise over the balance of your retirement. Now, there's another reason why it's important to be able to take a lot of risk in your stock market portfolio if you have guaranteed your living expenses through the income annuity with the Social Security or pension. Most of the money that you're planning on spending in retirement for those discretionary expenses has not even been earned yet. Okay. If you're going to cover the discretionary needs for a 30-year retirement, and we're talking when the carburetor fails, when the roof has a leak in it, when you have those unexpected healthcare expenses, when you want to take the grandkids to Disney World, what have you. There's all sorts of different things that can arise. You have to have the ability to stretch that stock market portfolio over a 30-year time frame. And if you aren't able to take a lot of risk in those investments, you're probably not going to be able to make those dollars stretch far enough. So when you guarantee your lifetime income, you have a permission slip to take more risk in the stock market. And that statistically increases the likelihood that your discretionary pool of money that you're going to be tapping into periodically over the course of your retirement will last as long as you do. I'm going to throw in one more bonus benefit, surprising benefit that stems from having guaranteed lifetime income. And that's simply this. You will neutralize two risks that have sent many a retiree's portfolio into a spiral, a death spiral from which it never recovers. The first risk that you can neutralize with guaranteed lifetime income is simply sequence of return risk. Now, sequence of return risk is that risk that you face that if you're taking money out of your stock market portfolio in the first 10 years of your retirement, and the stock market takes a dive, and it does that for 1 or 2 or 3 years in a row, when you're taking money out of your stock market portfolio while your portfolio is down, you run the risk of running out of money 12 to 15 years faster than people who do not have those down years in the first 10 years of their retirement. So sequence of return risk is a major risk that when you're not forced to take money out of your stock market portfolio because it's being provided for by that guaranteed lifetime income, you completely take that risk off the table. And the second one is withdrawal rate risk. The likelihood that, if you recall from prior podcasts, historically, people have withdrawn from their stock market portfolio in retirement whatever they thought was the prevailing rate of return in the market. For example, if they thought the prevailing rate of return was 8%, if they thought 8% was a reasonable rate of return to expect from the stock market, then they would take 8%. If they thought 6% was a reasonable rate of return to expect from the stock market, they could take out 6%. And as I show a couple of charts in my book that show the dangers of what would happen if you did that in a stock market environment that mimicked what happened from 2000 to 2010. So withdrawal rate risk is the risk that you run that you are taking unduly high distributions or withdrawal rates in your portfolio. You do not have to worry about taking unduly high distributions from your stock market portfolio if your income is provided in a completely different means, and that is by way of a guaranteed income lifetime annuity. All right, folks. So like I said, this is the first of 3 podcasts that you're going to hear in the lead up to the release of my book, Tax-Free Income for Life, on November 17th. Of course, if you haven't pre-ordered it yet, please do. And you can go to davidmcknight.com, input your receipt number, and get Chapter 1 completely free. And of course, that will give you a good taste of what's to come. If you have not subscribed to my podcast yet, please do. That will make sure that you get a notification every time we release a new episode, which happens every Wednesday. We haven't missed an episode in over 2 years. And if you would like to follow me on Twitter, you can do that as well, at McKnight & Co., at McKnight & Co. For those of you who follow Instagram, it's David C. McKnight, David C. McKnight. That is my handle on Instagram. And as always, we would love reviews of our books and our movie on Amazon or wherever you can write those reviews. Thanks so much. We'll talk to you same time next week.